Alright, let's dive into a fundamental topic in AS level accounting, depreciation. We're going to break down what it is, why it's so important, and of course, how to calculate it using the two main methods you absolutely need to know. So let's kick things off with a really practical question. Imagine a business goes out and buys a big, shiny new machine for $90,000. It's a valuable asset, no doubt, but you and I both know that machine isn't going to be worth 90 grand forever. So the big question for any accountant is, how do we properly and systematically account for that dropping value? Before we move on to the topic of today's video, I'm excited to announce that physical and online workshop batches for this year have officially begun. To level up your accounting skills, we will be revising the whole syllabus while solving yearly and topical past papers live. If you like to study at your own pace, you can also gain access to recorded lectures and notes of the entire IGCSE O&A level syllabus. You must visit our website at www.adeelpaperwala.com and head over to the resource section and feel free to study from all the free resources such as notes, PDFs, and coursebooks. If you want to know more about the workshop classes being held, head over to the contact section and feel free to inquire or message us on WhatsApp. The website link and contact details are provided in the description. And while you're down there, make sure to give the video a thumbs up and subscribe to the channel to enjoy free weekly accounting lectures, and drop in the comments if you have any questions or suggestions. Well, the answer is a process called depreciation. And this isn't just a random number we pluck out of the air. It is a systematic process. We're officially recognizing that as we use a tangible, non-current asset, something physical the business owns for more than a year, we are bit by bit using up its economic value. Now, this is a really crucial point. This idea applies to pretty much every physical asset a business owns. We're talking machinery, company cars, buildings, computers, you name it. But there is one major exception: land. Why? Because in accounting terms, land is considered to have an infinite useful life. It doesn't wear out, so we don't depreciate it. It's actually helpful to think of depreciation as part of a family of concepts. For tangible assets, the stuff you can physically touch, we call it depreciation. But for intangible assets, things like patents or brand recognition, the term is amortization. And if you're, say, an oil company using up an oil well, that's called depletion. Different names, but a very similar idea. For today, though, we are zeroed in on depreciation. So what actually makes an asset lose value? Well, it really boils down to three main culprits. First, you've got the physical stuff, just plain old wear and tear from using it, maybe a bit of rust and dust. Second, there are economic factors. Maybe it becomes obsolete because a newer, better technology comes out, or it becomes inadequate. It just can't keep up with your business's growth. And finally, you've got time itself, which is a big one for assets like a lease on a building, which just runs out eventually. So why is this whole process so essential in accounting? Why do we have to do it? It really comes down to two bedrock principles. First, the matching concept. This says you have to match the cost of an asset to the revenue it helps you earn, and you have to do that over its entire life, not just in the year you bought it. And second, the prudence concept. This is basically the don't lie to yourself rule. It stops us from overstating the value of our assets and our profits by pretending our equipment is still good as new when it's not. Okay, let's get into the nitty-gritty. We'll start with the first and honestly the most common method you'll see for calculating depreciation, the straight line method. The name itself gives you a pretty big clue as to how it works. And here's the formula. It looks pretty straightforward, right? We take the asset's cost, we subtract whatever we think we can sell it for at the end, that's the scrap value, and we divide that whole amount by how many years we think we'll use it. But to use this correctly, we have to be super clear on what each of those three pieces actually means. Let's break them down. Cost isn't just the price tag. It includes every penny you spent to get that asset in place and ready to work, so things like delivery fees and installation charges count. Scrap value, you might also hear it called residual or salvage value, is just your best guess of what it'll be worth when you're done with it. And useful life is your estimate for how long that asset will actually be economically useful to your business. Notice I keep saying estimate. Depreciation is all about making reasoned estimations. Okay, if you remember one thing about the straight line method, make it this. The amount you charge for depreciation is the exact same amount every single year. That's why it's called straight line. If you drew it on a graph, it would be a perfectly flat, horizontal line. Right, enough theory. Let's make this real and walk through an example from start to finish. We're going to follow a machine from the moment we figure out its cost all the way to what happens when we sell it off. First things first, we've got to nail down the true cost. So we start with the $100,000 list price, but we immediately take off that $20,000 trade discount. Then, and this is key, we have to add any costs to get it ready for use. So we add the $4,000 for carriage and another $6,000 for installation. That gives us the actual cost we put in our books, $90,000. Okay, now we plug that into our formula. $90,000 in cost minus a scrap value of 0 divided by a useful life of 4 years. That gives us an annual depreciation charge of $22,500. Simple enough, right? But what happens if we decide to sell it early? Let's say we sell it after just 3 years. First, we need to know the total depreciation we've charged so far. Well, that's just our annual amount times 3, which is $67,500. Next, we figure out the asset's net book value. That's the original cost minus all the depreciation we've charged, leaving us with $22,500. Finally, we compare that book value to the actual cash we got for it. So according to our books, the asset was worth $22,500, but we only managed to sell it for $7,500. That gap? That's a $15,000 loss on disposal, and that loss gets recorded as an expense in our income statement. And this is where it all comes together beautifully in the accounting records. Check out the disposal T account. On the debit side, we take the original $90,000 cost of the asset out of our books. Then on the credit side, we account for everything else, the total depreciation we charged, the cash we received, and that loss we just calculated. And look at that, both sides add up to $90,000, perfectly balanced. Now, here's a real-world complication. What do you do when you buy or sell an asset partway through the year? Businesses need a consistent policy. One common way is the full year policy. You take a full year's depreciation in the year you buy it and 0 in the year you sell it. A more exact way is the pro rata policy, where you calculate depreciation for the exact number of months you owned it in that year. Okay, let's switch gears completely. It's time to look at the second major method for calculating depreciation, the reducing balance method. And as you'll see, this one paints a very different picture of how an asset loses its value over time. Now, here is the absolute number one key difference. With the straight line method, we always went back to the original cost. But with the reducing balance method, we apply a fixed percentage to the asset's net book value. That's its cost minus the depreciation we've already charged. And since that book value goes down every year, the depreciation charge goes down with it. Let's watch it work. We've got a $50,000 asset and a 20% rate. In year 1, we take 20% of the full $50,000. That's $10,000. That leaves a net book value of $40,000. Now, for year 2, our starting point is that new $40,000 number. 20% of that is only $8,000. See the pattern? The depreciation charge is front-loaded. It's highest at the start and then gets smaller and smaller each year. So let's put them head to head. Straight line gives you a constant, predictable charge based on the original cost. It's great for assets that you think provide an even benefit over their life, like, say, office desks. The reducing balance method, on the other hand, gives you that diminishing charge based on net book value. And it's often a better fit for assets that lose their value faster at the beginning, like vehicles or computer equipment. And that brings us to a final, really interesting question to think about. Picture an asset where the repair bills are low when it's new, but they creep up as it gets older. Now, if you combine those rising repair costs with the annual depreciation charge, which method, straight line or reducing balance, is going to give you a smoother, more consistent total cost of ownership each year? That's a key strategic question accountants have to think about when choosing the right method for the job.